In this week's video, we'll review the latest charts to help us answer a question about the market's appetite for risk. Is it different this time? We've got a lot to cover. We'll be moving very rapidly. The video is designed so you can use the pause button on your video player. Let's start by taking a balanced look at the big picture. 100% of this week's video is being recorded after 1 p.m. Eastern Time on Friday. There are two very similar studies shown on your screen here. Both of them identified the signal dates by sentiment trader. Signal on the left side of your screen, S&P 500 after we see 2 out of 3 trading days with at least 85% up volume on the NYSE, and that occurs within 30 days of making a 52-week low. These are very similar signal dates on the right side of the screen. The standard's just a little bit different, looking at days that can exceed 87% NYSE up volume. As you can see over here with the tweet, typically when something similar happens, very good things happen on a longer-term time frame. Using this standard here, median gain 1 year later, 23% in the S&P 500, 100% of the historical cases positive. That doesn't necessarily mean that we go straight up or that the lowest low has been made even in those historical cases. You can see the average drawdown after the date of the signal using this standard here, 7% plus, median drawdown, fairly muted, under 5%. So let's put this data over here on the right. Your signal date is here, so these are drawdowns from the signal date, meaning hypothetically we could still backtrack from where we are today. If the 2020 case followed a similar path to the 14 historical cases, hypothetically, in 64% of those 14 cases, in the present day we would not exceed this low, and hypothetically the low would be in. In 36% of the historical cases, this line, this line, this line, this line, and this line, hypothetically we would exceed the present day low. And in some of these cases you saw multiple signals in the same bear market. Since this is the first signal we've seen in this bear market, it's really relevant to look at the first signals, which is what we're doing here. Here are your hypothetical drawdowns after the first signal. And from a timing perspective, if we followed a similar path, 72, 46 calendar days from the date of the signal, hypothetically the low would come between September 3rd and September 29th. Very similar to the median low the S&P 500 makes in a typical midterm year, speaking about elections. So in most of these cases here where my cursor's moving around, that aligns with this signal here that we've covered in the past, hypothetical average and median drawdown, and it also aligns with the possibility of running an accumulation strategy. While good things happened, in this case over here on the left looking out 1 year, you have to keep in mind drawdowns still could be in the cards. And that's easy for us to comprehend hypothetically because we haven't made a lot of progress relative to these bullet points. So relative to bullet point 1 and bullet point 2, the Fed's rate hikes are starting to have some impact on the economy, and more importantly, higher interest rates are starting to have some impact on the economy relative to the labor market and housing. The common theme this week relative to economic data was below expectations. And thus, the markets are forward-looking mechanisms, and they're expecting the Fed to slow the pace of the rate hikes and or to possibly cut rates next year. So the weak economic data that we're seeing increases the probability that we could be making some progress relatively soon on these fronts here. In this type of interest rate forecast here, where the Fed could be lowering rates later this year or in Q1 or Q2 of next year, seems to align with the possibility that the market could hypothetically bottom somewhere between point A and point B. And we want to keep an open mind about a wide range of outcomes. How about these significant drawdowns historically? We're still expecting to get a very high 75 basis point rate hike next week. And inflation, in terms of the data that we have in hand, is still very concerning. Relative to keeping an open mind about better than expected outcomes looking out 1 year, American Association of Individual Investors Bulls minus Bears. This is a sentiment survey. It's rare to get all the way down here where you're pessimistic and then make it back to the red line. You can see we did it here in 2009, back to the red line, and we did it here in the 1990s, from here to here. Those are the only two cases on your screen. We're using all the data going back to 1987. So we just did this in the present day back to the red line. In the 1990 case, when we got back to the red line, the S&P 500 had already made its lowest closing low. Similar situation in the 2008-2009 case. When we make it back to the red line, the low is in. Helps us assess probabilities. Percent of NASDAQ stocks greater than their 150-day simple moving average. All the way down here, extremely and rarely oversold. We just made it back to this line here. In the historical cases, once again, we're using all the data going back to 2002 in this case. In every single case, the low was in. It didn't mean volatility was over, but the low was in. When you make it here, the low was in 2002. You do have a painful retest in 2003, but this low holds. Here, you make it back to the upper blue line after the major low in March of 2009. You make it back to the upper blue line after the major low in October of 2011. Similar situation in the 2016 case. Sentiments down in this area here. When it makes it back to this line here, the low is in. Here, we're down in a similar area to where we are today. The low is in. And here, the low is in. And in the historical cases, similar to this point here, after you have horrible sentiment and you bounce, stock market was higher in every single case. 1 year later, 2 years later, 3 years later, 4 years later, and 5 years later. Doesn't necessarily mean the volatility was over. Maximum drawdown in those cases was double digits, 11%. Remember, there's a retest in 2003 that's relatively painful. Average drawdown less than 5%, the median drawdown approximately 5%, 30 calendar days and 5 calendar days. This is what those drawdowns hypothetically look like on a present day chart, and that would align with an accumulate strategy if the data allows. You can pause your video player here. Extremely rare pessimism. However, keep in mind, October of 2008 and 2001, the S&P 500 has quite a bit further to fall. And by historical standards, in terms of duration and magnitude, this is still a relatively shallow bear market. Thus, more pain could be ahead. With the economy starting to show weakness, it's possible that we could see inflation calm down in the second half of the year, and it's also possible that the Fed could cut rates. Possible. Also have to keep in mind that inflation is extremely high for the most part all over the globe, which may make it difficult to cut rates anytime soon. So while the market expects the Fed to back off at some point in the future, we have to be aware it's possible the Fed will reset those expectations. Given everything we know today, somewhat of a mixed bag relative to the data that we have, it's important to keep in mind that markets are forward-looking mechanisms, just like ARK peaked in Q1 of 2021 as market participants started to look forward. It's possible that the market could be looking forward to inflation peaking and looking forward to some type of Fed pivot, telling us to keep an open mind about the possibility of a bottoming process somewhere between point A and, let's say, point B. The S&P 500 is down over 1% intraday on Friday. However, the charts that we're going to cover in this segment will give us a better understanding relative to what we're looking for here. July 15th really hadn't seen a lot. It's extremely important for us to review the data in the coming days, weeks, and months with an open mind. If we already know what's going to happen, if something else happens, it's going to be very, very difficult to deal with it properly. This is from the July 1st video. At that time, S&P had possible support about 4% below, and if we didn't hold there, downside, additional downside, roughly 9%. Thus far, the S&P 500 is held in a logical level. If it doesn't, this is somewhat of an air pocket look here, and then we get down into that cluster that we've been talking about, and we do have some possible support in here as well. Some improvement relative to this type of data, nothing sustained yet. A lot of charts trying to make a stand near 200-week moving averages. Like everything else, we'll learn something either way. Often technical analysis is about subtle shifts. This is the first time since the market peaked, this ratio peaked back in November of last year, that we've been able to move above this trend line. It's a little bit different than what we saw here. This is 11:30 a.m. on July 22nd. Thus far, the NASDAQ has held in this cluster area. This is an important area. Another subtle difference. As of Thursday's close on the daily chart, this is the first time in this calendar year where the NASDAQ was able to close above the upper Bollinger Band. This type of look doesn't tell us whether or not a bottom is in, but it does tell us that we're seeing some type of incremental shift in risk appetite. And that aligns with keeping an open mind about an accumulation strategy. An accumulation strategy acknowledges that the market may have further to fall. NASDAQ weekly as of Thursday's close, trying to make a stand at that important 200-week moving average in red. Some guideposts relative to potential downside in an accumulation strategy here. Another subtle difference, NASDAQ 100 relative to the S&P 500. This looks different. Daily RSI, Thursday's close for this ratio, the highest of the entire calendar year. Like the NASDAQ, this is an important area relative to managing risk and reward. We're not expecting this to hold. It's like everything else. If it holds, we learn something. If it doesn't hold, we learn something. July 22nd, using the 10-day moving average here because we need to see something more sustained. Why are we sitting on so much cash? The data hasn't improved enough yet. To reduce cash at a more rapid rate, we're going to need to see something like this, or this, or this. It may happen very, very soon and hasn't happened yet. Some guideposts on the weekly NYSE. This gap here has never been filled. And during Friday's session, we're pausing at a logical area here. We get a band of volume by price support near the COVID peak, and then another significant band down here near that cluster. After Thursday's close, double bottom type look above the trend line. Not earth-shattering. It doesn't mean this is over, but it does tell us we could be getting closer. The concerning look would be this is an air pocket in here near this area of relative support. Haven't seen anything like this the entire year breaking this trend line. That would be the good news. The bad news would be brushing right up against potential resistance here. Subtle differences, potentially important relative to keeping an open mind in the coming days, weeks, and months. NASDAQ 100% of stocks greater than their 50-day simple moving average. On Thursday, highest reading of the entire calendar year. Things are starting to look a little bit better under the surface. No progress here on these longer-term breadth data sets. Same thing with the S&P. It's the first time we've broken this trend line here going back to March. You've got a nice tight cluster look. S&P thus far has made a stand in a logical area here. Not much support if that doesn't hold, and we would come potentially into that cluster area that we've been watching from 2020. Another subtle difference, Williams percent R. This is the entire calendar year, year-to-date 2022. This is the first time Williams percent R didn't backtrack and go into oversold territory. This tells us that selling pressure is relatively muted in here. Doesn't mean a low is in, but it does tell us we could be getting closer, or we're starting some type of bottoming process. Couple things here. Black ADX above red and green. Sometimes that tells you the trend is overextended. In this case, overextended in a bearish manner. You can see weekly momentum as of Thursday's close trying to turn up. Here's another data set where we need to see more. S&P 500 greater than their 50-day simple moving average. We made it back to this point here in 2002. This signal was early. The market had further to fall. Here in Q4 of 08, early 2009, again, this breath thrust here is early. So in the present day, we prefer to see this data set clear this level and clear this level. Haven't cleared either of them yet. Have a lot of charts that look very, very oversold. This one says be open to more downside. Interest rates. You can say this is the left shoulder, this is the head, this is the right shoulder, all hypothetical. However, this also aligns with an accumulation type strategy and the possibility of inflation coming down later and the Fed backing off a little bit later. As always, this commentary is related to the chart in front of us. In this case, Friday, July 22nd at 12:11 p.m. Eastern Time, just after lunch. Another very subtle shift relative to risk appetite. We held here in June, exceeded it on Thursday. Think of it this way. Risk appetite isn't binary. We don't go from everybody being bearish to everybody being bullish. It's typically a process. And typically a process that takes time with fits and starts. We've seen it in recent weeks. Things look good on June 24th. They didn't look so good in between. They look good for 4 days this week. They don't look so good on Friday. Even if we're in a bottoming process, history says we should expect more of that, alternating between risk on and risk off. In June, Apple could not clear these levels. Apple could not clear this trend line. Did both this week. Last week, ARK was down 8%, closed below the weekly trend line. Thursday's close, we were up big weekly, week to date, above the trend line. And during Friday's session, we were still up. Even if this doesn't hold, it's still a positive sign relative to a shift that typically takes time. Similar situation here, ARK versus defensive staples as of Thursday's close. Highest high that it's made in several months. The last time it made a low way back in May. For the calendar year, entire calendar year, the true strength index for this ratio has never been above 0 until recently. Subtle, but potentially meaningful going forward. Weren't able to clear this trend line here any time over the past 9 months, going all the way back to November. We've done it now. We are in an area here with ARK. If we made a stand in this area here, even if we came back down and made a stand, that would be logical. Last week we said we didn't like the look of this chart. We wanted to see this white space filled. This chart is dated July 14th. July 22nd at 2:16 p.m. Eastern Time over here. Also noteworthy, S&P 500 at 2:17 Eastern Time, down 56 points. That would be the bad news. The good news would be we're still above this high that was made here, and we're still above this high that was made here. This is earlier in July, and this is back in June. Really, the point of this segment, if you went back and watched the video on June 24th right here, the probability of the low being in place was higher here than it was down here. Similar situation today. The probability of the low being in place is higher today than it was back on June 24th. The key word is probability. Under our approach, we're really not trying to figure out if this is the low. What we're trying to figure out, what's a prudent and reasonable way to reallocate our capital. And that includes having a strategy if the low is in place, and that includes having a strategy if we're going to fall somewhere in the order of 18% from this level here. and everything in between, and everything outside as well, open to a wide range of outcomes. This corporate bond chart that we covered in a previous video, this is dated July 7th. Subtle shift during the entire decline going back to December of last year. We've never been able to clear this trend line. We did it this week. This is a nice look here with stochastic RSI. LQD up for the week as of lunchtime on July 22nd. We know, all things being equal, we'd prefer to see LQD in the credit markets bottom. Could be the bottom, or it could be part of a bottoming process. October of 08, you still have a long way to fall after the counter trend rally into early January of 09. But it is part of the bottoming process and would align with an accumulation type strategy. Subtle difference. Netflix has not been able to clear this area here for several weeks. It did it on Thursday. This is one of the charts back on June 24th that we said keep an open mind. Keep an open mind back on June 24th. July 21st, still held here on the QQQ gold ratio. Is it possible we're going to come all the way back to this level here? Sure, anything's possible. QQQ SPY trying to make a stand at the 50-month moving average speaks to the secular trend thesis. Last week we said indecisive here. Here's another subtle shift. This ratio making a multi-week high as of Thursday's close here. Come back down a little bit here during the session on Friday, but this is still an improving look. If we closed here, that would be the highest weekly close in quite some time. You'd have to go back to April. Another subtle shift. Rejected here in April of this year. Thursday, we closed above that trend line. Not earth-shattering, but meaningful. One of the June 24th charts said keep an open mind. Still above around lunchtime on July 22nd. Chart we covered previously, July 15th. I believe we said in one of those videos, if you're a stock market bull, you'd like to see this trend line broken as a good first step. We are below the trend line as of lunchtime on July 22nd. Thursday's close. High beta stocks relative to low volatility stocks. Big bounce at the 50-month moving average, up over 12% month to date. Another subtle shift. We weren't able to break this trend line here. We broke it as of Thursday's close. Last week we said we didn't like this look. Looks a little bit better this week. During Thursday's session, up 1.8% roughly for the week. You can see negative momentum waning. Still indecisive. Another subtle shift. S&P 500 divided by low volatility. This is the strongest look we've seen all year. Now, this is as of Thursday's close, but it's still the strongest look we've seen all year intraday on Friday, and the ratio was still up 2.34%. Also notice on this decline, white space between price and the lower Bollinger Band, a subtle difference relative to this, and this. This aligns with it's possible that inflation will peak in the coming weeks and months, and it's possible that the Fed will pivot. Here's another chart, value versus equal weight S&P 500. This looks different relative to anything we've seen since all of this started back in November when the NASDAQ peaked. Even during Friday's session, still well below this trend line. Value relative to growth, for now, turning around at the all-important 50-month moving average, a downward sloping 50-month moving average intra-month. Similar concepts, daily RSI for value versus the S&P 500, lowest reading of the year as of Thursday's close, below the trend line. Not dead in the water by any means, but starting to get a little more vulnerable. Subtle shifts. Back on June 24th, we said you could make an argument that XLK divided by SPY, this was the best tight look of the year. Look at the hourly chart going all the way back to December of last year. Subtle difference. We've never been able to clear this trend line until the month of July. Notice the basing look of the 200 period moving average on the 60-minute chart. There's a basing period here, above the trend line here, a different and subtle look. The 50-day moving average trying to turn up down here looks basically the same during Friday's session. All things being equal, if you're a stock market bull relative to inflation and interest rates, you'd prefer to see this ratio hold above this gap. It closed above it on the weekly chart on Thursday and was still above it during Friday's session. Not quite there yet on this chart, but starting to look a little bit more like this and a little bit more like this, where good things happened in the S&P 500. Good things happened in the S&P 500. We don't want to get stuck on any story. We don't want to be stuck on any bearish economic or market story or get stuck on any bullish economic or market story. You can say the same thing about the Fed. You can say the same thing about inflation. That works out really, really well if you're right. It typically doesn't work out very well at all if you're wrong. You can make an argument this is a double top here. However, this is still in an uptrend for now. Some improvement here and some basing on this ratio. And even during Friday's session on a closing basis, we were above these levels here. This is a daily chart, XLY divided by XLP. What are the main takeaways here? For us, based on this support model that we've got here, and it uses the NASDAQ, Dow Jones Composite, the Industrials, NASDAQ 100, NYSE Composite, S&P 500, and the S&P 500 equal weight. Intraday on July 22nd, we're about 8%, 7.5% away from support. Let's call that support level 1. If that doesn't hold, the downside could be an additional, let's call it 10 to 11%. And recently, when the S&P 500 was down here, these numbers here, we were only about 1% away from support, and that support that we've been talking about and monitoring held. So thus far, that's been helpful. You can see if it doesn't hold, here's your air pocket look in here, it's possible that things could get ugly again relatively rapidly. It's possible. So we've seen some subtle shifts, but how much real progress? And remember, this is based on these signals, similar situations to what we've seen in the present day. We want to get out here. This is wonderful one-year performance, but we want to avoid these big drawdown cases. So this is the type of transition that we're looking for, full bore bearish to full bore bullish. This is the 1962 case, which is right here relative to these signals, and right here in this table, and right here in this table. So in the present day, if we had something like this, let's say orange turning up, that would be constructive. We don't have that. Orange is way up here during Friday's session when the S&P was down 29 points approximately. So we do have some signs of improvement. This chart here, S&P down 53 points approximately at roughly 2:30 p.m. Eastern Time on the 22nd. And once again, not that big a deal relative to this rally attempt, which may be successful, it may be unsuccessful. Right now, it still looks pretty good. So the scoring system that was based on these similar cases, where we're trying to get out here, how much progress have we made? As we covered previously, as of July 8th, not a lot. We could check less than 1% of those bullish boxes. And as you might imagine, we're a little better today, but not much better. During Friday's session around 11 a.m. Eastern Time, still couldn't check 5% of the boxes, and that's been a fairly consistent number. It didn't move a lot during Friday's session. Bottom line, this is potentially a good start, but the market has work to do. You can see here we've got green, flattish, blue up, red up. In this one anecdotal case, green, flattish, blue up, red up. Still had work to do. It took several weeks. We almost went all the way back to the previous low. If something really good is going to happen, It's really not possible mathematically for this chart not to improve significantly. We have a ton of data in hand that tells us to be open to a bottom or a bottoming process. These are setups. This is a good sign. It's a baby step. Not trying to make the case that the low is in or it's not in. Things look better relative to bottoming probabilities than they did even a week ago. If history is a guide, we maybe have a 5 to 8% drawdown window if this rally is relatively successful. And if it isn't, and we have another leg down, maybe we're looking more like 8 to 18% from current levels. The game plan is to accumulate at a rate that's in line with all of the evidence. This is one piece of the weight of the evidence. We have to be open to some type of longer-term thrust. Haven't seen it yet. Just as the markets were forward-looking when things like ARKK peaked well in advance of the Fed pivoting, it's possible that the markets are looking forward now, and hence it's possible we are starting a bottoming process prior to a formal Fed pivot. Topping tends to align with bottoming. What does that mean? When you get a long-term dome-type topping process, you typically don't get a V-type bottom. When you get a V on the way down, a waterfall, not unusual to get a V on the way back up. So that tells us it took time to top. It wouldn't be shocking if it took time to bottom. This bullet point here cannot be overstated in the present-day environment. The low could be in, or if it's a 2008 type case, we could have a significant drawdown still ahead. For now, inflation is a problem. It's a problem until it's not a problem. Thus, we all know the only way any of this is going to work is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.